Estoy esperando a Adrián que me diga. Hello. Buenas tardes a todos. Hoy la presentación va a ser en inglés, so I'm switching to English now. We have with us to Mark Howard. He's the CEO of Causality Group. It's a proprietary trading company in Madrid. He's sponsoring the Robotrader competition this year, so I thank you for this great decision. Mark Howard worked as quant in Morgan Stanley, was developing factor models in MSCI Barra. Then he wrote a lot of papers about machine learning, mathematics, option portfolio optimization, things like that. He was also a quantitative portfolio manager in a an Oxford-based hedge fund. He's now here in Robotrader competition. He's gonna talk about factor models, and we are very thank you to him because he's here. He has a very tight agenda. He has, in fact, this presentation will run till 7 because he has to take a flight afterwards. And so it's your turn. You have the mic.
Okay. Thank you very much for the introduction. During the presentation, please feel free to stop me, ask any questions. I could also speak in Spanish a little bit. Probably you wouldn't enjoy, so I stuck to English. In general, I want to show you how I want to speak about two things. One is factor modeling, which is a mathematical technique. But I want to focus on the implementation side. Basically, I want to show how great tool Python is to really do factor modeling, which is this mathematical technique, factor modeling or any kind of quantitative analysis. To do that, well, this is where we're going to. So we're going to take individual factors. These factors, one by one, will have some kind of Sharpe ratio, some kind of profit. And combining those factors, we will arrive to an even better signal than the individual factors, one by one. These are examples of univariate factor returns. Some of them are like reversion, momentum, growth. Each of them are different ideas which generate returns on their own. And then we look at these as tradable assets, like they would be independent portfolios. We combine them, and then we arrive to this even better composite. Idea to use factors and signals in an interchangeable manner. That's not always the case, but in this presentation it will fit our purpose. So, to really get here to these factors, we had to try hundreds of parameters of each factor. We had to build expert combination algorithms that are selecting the factors online. We could do it also in another way, but whatever way we choose to do this, it's going to be a lot of data munging. So we'll have to generate returns for all kinds of assets. We have to generate transformations of those returns. We have to generate moving averages. We have to generate a lot of things which we would have to repeat, and it would be very slow. So the whole thing, this whole quantitative trading is in fact very similar to data science. So we had a lot of data providers. We get the data and we build systems that help us to manage the complete data infrastructure. Things that will reoccur and we want to support with our Python platform is generate, saving, loading, backtesting trading signals. We will have to combine these signals to even better performing signals. And then we have all kinds of maximizations that we had to implement. Another thing is that once you implement one model for a certain market, like you build, we started on equity markets. Once you have a model for equity markets, that's relatively easy to use on futures, for example. You can use the same machinery, you just have to put different returns behind. So you would repeat even more calculations as you grow your company. So we chose Python. Why do we love Python? One of the main reasons is that it has a lot of statistical tools. Actually, these guys are very good at stealing things from R. R is well known for very good statistical tools. And then the greatest thing that they store, for example, is this pandas data frame thinking. So we have some data storages which are really easy to use and really help the research. And at the same time, it is a proper programming language. So you can use classes, you can use functions, you have a integrated development environment, you have continuous integration, you have bit integration. Basically, it gives a bit from both worlds. It's not a magic bullet, not for every task Python is the best, but if you want to build a production system and you don't want to replicate your research and then copy all your research into a production system, then it really helps a lot to choose a language that can do both. One of my favorites, for example, is doc testing. So I want to show you how this works. Well, I hope I don't break it. So then we have the notebook interface, which you are probably familiar with. I'm going to show the notebook just to show how the complete platform works. We are implementing in PyCharm, which is a full-blown development IDE. And one of the fancy things it knows is this test. So we have this function, Occam ID ticker. Occam is the name of our factor model. And then this Occam ID ticker should take out the ticker symbol, Occam ID. So let's see how this works. We generate ticker exchange and asset type, and then Occam ID looks. So we are doing documentation while we are testing. So this test should really return. So let's say there is a mistake. The program code doesn't really generate what is expected by the doc test, by the explanation on the function. Then we will get an error. So it will say like, hey, I actually expected this string, and the output was this string. What was printed on the screen was different. So we can recognize this and correct the mistake. Now I'm just going to make this back. Really, the trick is that with the click of a mouse, I can test my function. Just when I implemented it, I put there an example like, hey, you would use this function this way or that way, which is also an explanation and also a test. This is one of the things. There's like so many things that an IDE gives, even in a research setting, because initially your research is just like few functions, few pages, but then if you build a company, a data platform is going to be hundreds of thousands of lines, and then all these little differences will really help. So this is one example of the benefits of Python, and they collect these ideas continuously. The other one is that Python is known to be is a binary language. It's interpreted, it's continuously interpreted, so it's not compiled to machine code. But with a bit of a change of the language, we can make it as fast as C++. So in this corner, you see a typical Python implementation. The function call is going to be very slow. All these operators will be slow because it has to figure out what's the type of the object. It's a dynamically typed language. And then there's going to be a loop, which is also very slow. So this is like typical R, MATLAB speed, or anything that's an interpreted language. But if you just change the syntax a bit, so you specify this tag here, that now this is going to be Python, allows you to specify the types of your inputs. So you can say, input A is a double, input B is a double, input N is an integer. And at that point, this thing will compile to something, to proper machine code. So it will know the types, it doesn't have to think at all, and it's going to be super fast. Okay, so that's just the general choice of the language. I'll show some tricks that we have built. To show that, I'm going to start this other environment, the notebook environment. How many of you has used Python for research before? Okay, great. So a lot of new information here. So one thing was the ID. The other thing is that I did my research before mostly in MATLAB. And then I It was typically like I wrote a file, and then I ran the file, then I had a lot of plots. A lot of plots appeared in separate windows, then I had a lot of output in the console, and then 2 weeks later I had no idea how I generated these plots, what was the string. I mean, I tried to save them in a good manner. But with this platform, actually you can get plots, text, and the code on the same web page, which you can save and transfer to any format. I'll show you how this works. So what I wanted to explain using this is that I promise that we will automate saving. We never have to figure out what's going to be the name of a file or where to read. Basically, using second-order functions to change the behavior of lower-level functions. So let's take this function, myFactor. We just defined it, and it's going to return a data frame. At this point here, with this persistent partial, we are changing the behavior of myFactor. MyFactor is a function. Then we apply the second-order function, and it becomes a new function. And this new function, the cached myFactor, will have an additional property, so that other than it will still return the same data, the calculation that we are calculating with the factor. It will also save the results on the disk based on the name of the function and based on the arguments that we have provided. So all our calculations will be automatically saved on the disk, and if we calculate next time, they come from the disk. They told me never do live demos, so let's hope this works. Yeah, so what we did is that we called myFactor that first ran through the persistent partial. It calculated the factor value inside, and while the value was coming back, it actually saved it on disk. This is the way that we are persisting any research, any data in our environment. Again, there's a lot of benefit of the research environment being the same as the live environment, the data environment. Like this. So this is, sorry, the resolution is quite small. That's better. So at the data, we have these data environments. Now there's only two. In the data environment, we save all the functions that we have ever run in the system, and we wanted to cache them. And each of them are quite readable. So like now, I really know where I saved my data. And at the end of all the folders, here is also the date range of the calculation. So now we ran this factor from 2003 to 2004. And then we have an HD5 file, which is a high-definition data format. It's a fast storage format. So that's one trick that we do in the system. We have this persistent partial. It can help us with many other things. One trick is that it knows time as well. So now we calculated 2003, 2004. What happens if we calculate 2003 to 2005? So the logical thing will be that the beginning of the data will be just read from the disk, and the rest will be, only the rest will be calculated with the function. So if we call this, we can see that indeed this happens. So before, we already had there the first year. That's still there, is the same folder. But now that we ran the function, it actually calculated from 2004 only on the residual time that we're missing from the calculation. All these second-order functions are strongly supported by Python. If you put your second-order function in the beginning of the function definition, it's called a decorator, then automatically you're applying this persistent partial on the calculation. So our program code really looks like we have all kinds of calculators, and in the top, we always have a persistent partial, so the results will be cached automatically. We put like other small things on it, like you can decide to save on CSV as well. So the result will be there as CSV if anyone wants to open in Excel or another system wants to pick it up. And then we also have a memory cache. So if a file was used in memory already once read, then it's just going to use the memory version of the same file. So this is one trick we do. There's another trick, which is making calculations parallel. So this myFactor, so this is a new notebook. This myFactor is actually defined in the code. it looks like this. So we have my factor, the same thing. We have a persistent partial, but on the top we also have this iterate parallel. This is another second order function. It's also a decorator. And what it does for us is that, let's try to run this. First we run it. Then we find that indeed it has generated some data in a particular path that we have instructed it to use. But when we call it second time, we do a trick. For every argument, you can specify for every argument, you can put this iterate suffix, and there you can specify a number of items to calculate. So when I run it here, it is actually running things in parallel, in multiple cores. And what happens is that instead of just saving the cross, both for this parameter, the 1, 2, we list the folders below, we list for that both of them got generated, and inside those there's a lot of new calculations now. So this is the basic. This is the model that we have built. So I'm going to build a factor. I'm going to show one sample factor just to give an idea. So let's start somewhere here. This thing is going to read returns for the US market. In the return DL, we have all the US market returns between 2010 and 2018. Some magic that the pandas is doing for us is that if you name your column strings, then the strings can become like members of the data frame. So we can simply use tab complete and simply pick a ticker that we are curious of. Like, let's see what's in the column of IBM. The data frame. Returns are like open auction, close auction. So 9:30 at the US market is the open, 4 o'clock is the close in the US market. And instead of just storing one timestamp, we are storing 2 timestamps. This will help a lot to actually backtest models. Once you know where used to generate signal, so you know when your signal is observable, and then trade it, for which you have to know where the return is starting. So bring 2 things. This return here, the first return, is starting from the 27th, 9:30, and it goes until the 27th, 4 o'clock. Then the next return goes from 4 o'clock, 27th, to 9:30 on the 20th. So is this 2 return per day, 1 until the open, 1 until the close, until the next open, until the next close. And we store both the beginning and the end of the return. So let's see how this looks like. And put your plots in the same place where you put your, and you also put your textual output. Anyway, these are cross-sectional average return. We can see that volatility is changing across time. This one I'm familiar with. This is 2015 September. China was going bust, so there was a big jump on all the companies in US as well. So let's try to take some ideas. This one is going to be the autocorrelation function of IBM. We're just looking at IBM here. Autocorrelation function means that if we lag the IBM return by 1 period, then we are going to get a -1% correlation. If we lag it by 2, then we get a slight negative correlation. Basically, there is something very obvious here, is that IBM is doing some kind of reversionary behavior, because in the beginning of the chart, so probably from here until here, on average, there's a negative correlation. So we can see that would we trade the negative return of IBM in the past 15 periods, probably we would be making money. So this is only IBM. And then let's see how this works. Then let's see how we can use this to build a factor. In a simple example, I'm just going to use IBM's return shift. So in this return df, now we have, and we are generating just by shifting the returns by 1. So that means if a company was losing money yesterday, there's a negative sign in the front. So if a company was losing money yesterday, then we will want to buy it. So the signal is positive. If the company, then we want to short it. We want to sell it. So this is the factor. Then we do a trick. The factor right now is all kinds of returns. To really calculate the return to make tomorrow, it has to normalize these factors so that it feels like investing $1. So this one signal is like you look at the cross-sectional sum of your factor. Let's say it wants to invest 2 cents in IBM and negative 2 cents in Apple. Then we normalize it in a way that it's going to be half IBM and half Apple. So it feels like investing 1. Basically, we're normalizing the cross-sectional, the factor cross-sectionally to be to 1. To calculate the return on all the assets one by one and sum it like reality invest $1. So let's do that. The magic is that the factor is still looking like the IBM time series looked. So we still know what is there. So now it's going to be very important that we know that the factor, this value, this signal, is actually observable at 4 o'clock at the close and not before. And then we want to multiply that with the same return that starts there. And because we know, because our returns also contain the start date, so we know that this return actually starts at 4 o'clock, we can automatically match our signals to the. And this is what we are doing in the next. We have this causal operation, which takes the factor as something that has to happen. First step is that cross-sectionally, I want to invest $50 to IBM long. And we multiply that with the IBM return in the following period. The same, it wanted to invest minus $50 into Apple, and that we multiply with the return in the next period. So this data frame contains the profit per asset. And that we will just sum across the cross-section and then plot it. Well, we forgot something probably. Just did before here, don't know why. Rolling mean is fine. So we're doing a window one rolling mean. Basically, we're just keeping the return itself because the timestamps take care of shifting the data across the time. So anyway, what we got is a sharp 2 signal. This is a cross-sectional signal, so this would invest into, let's say, 1,000 companies every day. We have ignored the transaction cost. We have ignored liquidity constraints. When some of the 1,000 companies are not very liquid, even less in the open and the close auctions. So this is not going to make anyone rich. It's a public algorithm. I mean, reversion itself is a very well-known, well-documented quant signal. But it serves as a good example of how to build how you can build a factor just by ignoring all the transaction cost, all the liquidity, all the difficult things we ignore at this level. And then what we do is that. So this is one of our factors. Out of these 10 factors here, one of these is reversion. And then we have a lot more ideas like seasonalities, all kinds of fundamental data, machine learning algorithms. So each of the factors are a different world. Okay, so now we have this mathematical framework. Basically, let's assume we have NA assets. Let's say we have 1,000 assets. So every day we will have returns for those assets. And then we will have a number of factors. So a factor is a value for every asset every day. But also we will have, let's say we have 10 factors. So NF is number of factors is 10. So that means every day we have a matrix of data of the factors. That usually we show this way. This is the matrix X. And let's say in the first column we have reversion. The second column we have the growth factor. The third column we have the volatility factor. So there's going to be a lot of data and a lot of factors in any factor model. And then the trick I explained is that we do normalization to 1. So we make our factors to sum to 1. So they feel like investing $1. And then once you do that, then you can simply calculate the return of your factor by a scalar product. So here, you're calculating the return of the jth factor across the asset dimension just by multiplying with the returns that follow. We are optimizing Sharpe ratio. How many of you is familiar with the Sharpe ratio? Who is not familiar with the Sharpe ratio? Okay. So the idea is that this proportion is some kind of signal to noise. Basically, we want to maximize our signal to noise because, okay, if I'm investing my own money, I want high returns, right? Everyone wants just to multiply it as fast as possible. But when you are in an investment company, you can actually borrow money. So in that case, you will say like, okay, I want 10% annual volatility, and inside that, I want to maximize my profits. Basically, we don't want the returns to go crazy because high returns usually come with high volatility. So let's say someone makes me an algorithm with 10% volatility and 10% growth. That's called the Sharpe ratio of 1. If someone else is making me maybe less return but even less volatility, so let's say he makes 5% return but only the quarter of the volatility, so 2.5% volatility, then I go to the bank, I borrow 4 times the money, so then I'll actually have 10% volatility on my initial investment, and then my profits are actually 2 times more. So the Sharpe ratio is really signal to noise because you just want to fix the noise and you want the strongest signal. And we can scale. In trading, you can easily change the invested magnitude. So to optimize this is a well-known formula. This is coming from portfolio optimization. So it's kind of the same framework. You have weights of as many assets you have. The weights, you normalize the weights on some way. And then you have expected values. You know the expected values of your assets. You know the covariance matrix of your assets. And then you want to maximize the Sharpe ratio. So you have to believe me that this is the Sharpe ratio. We multiply the weights with the alpha, with the profits of every asset. And this is actually the standard deviation per asset. So once you have this, once you know what you want to optimize, this is going to be the optimum. So what you have to do is that you have to invert the covariance matrix and multiply it with the expected values. This would be the magical formula, but the real problem is that you have 50,000 stocks. You have only very short analysis time. And once you can't really observe the covariance matrix, then it will be very difficult to invert. So this inversion itself is usually killing the whole thing. So the typical portfolio optimization usually doesn't work, and it doesn't work for the inversion problem. This is a difficult mathematical problem, statistical problem, and it really comes from the fact that there are much more assets than observations. So this matrix has a huge dimension. So what we are finally doing is that instead of doing this in the asset level, we are going to do it on our factors. We go back, just to show the factors again. So we only have 10 factors. Despite the factors are trading hundreds of assets or thousands of assets, we only have 10 factors. So what we do is that we observe the expected growth of every factor. We can just average the historical growth. We can see it's quite stable. And we can calculate the historical correlation matrix.
solve the problem?
I see. The difficulty is statistical, so the calculation time is very fast. We can calculate it very quickly. The problem is that inverting the estimated correlation matrix will be very far from the inverse of the original matrix. So we have the original matrix, but we don't know this. Only God knows this, this matrix. The thing that we know is like a short-term time estimate. We took a few years of observations. And then the problem is that what we want to shoot at is the inverse of this guy. But the problem is that the inverse of this guy is like very different. One thing is that it doesn't equal, of course, but the noise is getting amplified through the inversion problem. Are you familiar with PCA? That is another factor modeling technique. Okay. Anyway, there's a typical thing there that could explain. But this is just difficult. We do all kinds of tricks. I mean, the best trick you can do, one of the best tricks is to say like, I just forget. I know that this is very noisy. One of the great ideas is to say like, let's make it identity. Because then, what happens then? What happens is that you invert the identity matrix, you did nothing, and basically you will invest proportionally to your alpha. You'll put more money in the assets that are making high alpha, you think that they make high alpha, and you put less in the ones that make low alpha, or you go short in the ones with negative alpha. So there are all kinds of tricks. One is this inversion. The other one, you could keep the diagonals, so keep the variances in the diagonals of the covariance matrix and only make the rest 0. Or you can do shrinkage, another technique that deals with this problem. And that's really the power of factor model. Like, instead of modeling thousands of assets independently, we're modeling some groups of assets, some special assets that now we are grouping based on their trading properties. The big trick is that we can reduce the dimension. So if a portfolio manager comes in the morning and he says like, hey, we lost a lot of money. Why did we lose money? So you tell him like, yes, you lost on IBM, you lost on Apple, you lost on this one, and you made money on that one. It's okay, so what's that? But once you show him the factor returns of his portfolio, and he knows how much he invested in it, he'll be like, ah, okay, reversion is losing today because there was Brexit and there's huge momentum in the market. And we'll be like, oh, okay, that makes sense. We lost money today because of unknown reason. So it really helps to explain what's going on in the background. So then once you apply this, then you arrive to your final model. Using that technique, we're not using this directly, but we are combining the factors with some of those techniques that I mentioned. And then we arrive to a signal that's better than any of the others. Actually, we could check this. So this has a Sharp of 8.61. Do I have a mouse? So yeah, so it has a Sharp of 8.61, and it makes 14 basis points per day. And we made that from our factors, where the strongest factor had a Sharp of 6.5. So that is an increment. After we combined them, the final signal got stronger than the other ones. And also the strongest made only 11 beeps return. After doing the combination, the return has increased also by 40%. So thank you very much for your attention. If you have any more questions,
Time for questions.
I'm open.
You explained one factor, but how do you combine them all? I mean, to get that curve, how do you combine it once you have all the 10 separately?
So after we have all the 10 factors,
yes,
or whatever, now we have much more factors. This is an older picture. We calculate historical returns, so we know what's the expected alpha in each factor. We calculate the covariance matrix of them, but only the time series covariance matrix of these factor returns that we are seeing. And those are the two observations that we use in portfolio optimization. So we start to think this whole this whole slide actually speaks about assets. This is the typical application of portfolio optimization. But in asset space, it's actually very difficult to use this formula because there's very, very, very many assets, and you will have the covariance inversion problem. So what we do is that instead of using on assets, we're looking at the expected factor returns here. So we will have 10 numbers of alpha, like we know that, I don't know, reversion is making 5 basis points, the other one is making whatever basis points. Then we calculate the covariance matrix, and then we are trying to do this. And then this is under heavy research. We are always changing how this formula works. This was one of the initial versions. We really inverted the covariance matrix. It did work, but very badly. The second one was that we actually assumed that the correlation matrix is just identity. And then we didn't have this problem with the inversion anymore. The Sharpe ratio of the composite signal improved a lot when we started to do this. And then we keep implementing new ideas on how to make the combination better. So once you combine the factor, for the factors you can think of as independent portfolios. After all, these are just like, each of them are like a portfolio vector every day. So once you know that you want to put some weight on reversion, some weight on the other one, then you will just sum these portfolios in the weighted manner to get the composite signal.
And why don't you use a shorter time frame so you have more samples? So you've mentioned that the sample is a problem. You have a bigger universe in comparison with only 252 days.
Mm-hmm.
You can shorten the time frame so you can have more samples, like minute bars, for example. Can you scale that to a 1 minute bar time frame, for example?
Yeah, that's a great idea. Exactly. So we could increase the frequency to get more observations. Yes, and some people do that. Exactly. So this is actually a sensible idea. Basically, another idea to use to improve this estimate. And one way to improve this estimate is to take, yeah, indeed, 5-minute returns, calculate the covariance or correlation in 5-minute bins. So you will have a C hat 5 minutes, and then you will take a weighted average of the two probably. So you have to imagine that there are also other effects at play, so the 5 minutes is not exactly going to be the same. This is a great idea. I mean, I would be happy to try. We tried other ideas as well. For example, instead of looking at the correlation of the time series, we looked at the correlation of the factor values, because we have 1,000 factor values per day, so we had 1,000 times observations. That didn't help, so we gave up. This one could help, and then we would keep it. That's a great idea. All right, any more questions? Feel free. Puedes preguntar en español también.
Mark, in my view, using just 1 year of time in your research is a very little time to to perform the study. 252 days is
Exactly.
It's a very short span of time.
Exactly.
Are you thinking of expanding that amount of time?
So usually when we put the model, here I put 1 year in the example just to emphasize how difficult is the inversion problem. What we usually try is there's always a trade-off between recency of our estimate. Basically, let's say there's alpha decay, the signals are getting weaker. So then we can estimate this alpha vector. We could estimate based on 1 year. We could estimate based on 5 years. We could estimate it based on half a year. And when we are doing research, we try all these values. I don't like to fit the model, so I don't like to put a number like that inside the model. So let's say if the result is that actually 0.5 works the best, then I'm going to put an expert combination of all these three. That's going to be on on some way, non-anticipating expert combination is not going to look at the future. Every day in my backtest, I'm going to use the values that have been performed the best in the past of that time. And then I see if whether also after combination it works better. This is a tricky method. We could also do statistical significances and just see, like, is this really so much better to make it worse? Unfortunately, this is the first idea that many researchers try. I tried myself, and then I can never convince people that actually what works is that we put here infinite. Surprisingly, the statistical error from the short observation is bigger than the inaccuracy of our observations. So finally, as you're saying, we should really use longer window, and what we found to work in practice is even the longest window, like landmark window. It always goes until the start of our history. We start at 2000. So every average, at least the expected value and the covariance matrix averages are calculated from start of the time. So yeah, it was just an example in that slide. Whenever we're choosing models, we try to take as much history as possible. This chart starts at 2010. In the company, we actually use 2007, so we want to include the financial crisis. We want to test our risk control mechanisms running through the financial crisis. Usually the longer is better, indeed.
A practical question. Did you go real with this approach? I mean,
yes, definitely. This is how we trade.
And how was this in comparison with the model? I mean,
you mean how this method or the factor model itself?
You have all commissions, fees, and slippage and everything.
I see your question. Yeah. So what happens? I don't have those figures here, but when I generated this was something like 1,000 assets, as I remember. Our universe was the 1,000 most liquid assets. So we had a pretty high Sharpe. Lately, we are trading the S&P 500, which are very liquid. We have to apply liquidity constraints, and then we have the transaction cost. So what we have is that there we have a backtest Sharpe of 3.9, and this is without transaction cost. And then the backtest with transaction cost, after taking care of liquidity constraints, we get a small reduction only, like becomes 3.5. There is significant reduction, but you have to do some tricks to convert your model to something that you can trade. So if your model says, like, this is the distribution of my signal, it's like there are companies I like a lot, ones that I want to short a lot, and there are these, like, not important companies. Actually, we cut out the middle of the signal. These guys we don't trade, we don't trust. Also, we subtract the transaction cost, even more than that. We just ignore the ones that we are not confident of. And after doing all that, we are left with a sensible Sharpe.
Okay. Yeah, I think we didn't expect the Sharpe ratio to be so high. I mean, even in a backtest or a fitted model, or without commissions, but it is a quite impressive Sharpe ratio.
There are a few tricks that we are applying. I didn't explain everything. So these are all independent ideas, and these are the Sharpe ratios of the independent things. Most of the people are actually modeling day to day. We went intraday because there are more patterns if you go to the intraday scale. That helped us a lot. We're also neutral. What we're doing is that we're not really working with returns, as I showed now. It would be a longer presentation. Basically, let's say you build a portfolio and you want to bet on, you have an idea, let's say reversion. And then you create this prediction. Somehow you choose some of these assets to trade. But then finally your portfolio has a beta to the complete market. So if you analyze the market, if you look at the returns of all the companies, that usually looks like one. The other is slightly different, but it's doing something similar. I'm trying to draw similar waves, but they are slightly different. Basically, we could say that the principal component of all these movements is actually the average of them. And that's the problem. If you're actually betting on all your assets and you're not hedging out this principal component, that means you have invested in 1,000 companies. You thought you have 1,000 independent bets because you put your money in 1,000 companies. But after all, you're more long than short, let's say. That means you have a positive exposure to SPY, and instead of uniformly distributing your independent bets, you have 1,000 small independent bets, and then half of your money is on SPY. It's going to mess up everything. That's one of the main reasons that these results look much better than simply the returns that we would trade on the markets without subtracting the principal component. That's an additional trick. It's just most of the hedge funds are trading like this. So when they say they are long, short, beta neutral equity fund, that actually means this technique that they try to stay away from betting on S&P. They want to build 1,000 independent bets on the single companies.
Have you measured the level of correlation with the SPY 500 that you have?
It's like 0.1. So it's
0.1?
Like we hedge it out.
0.1?
Yes. We really hedge it out. Like we calculate our correlation to once the portfolio is ready. There's many ways to do it. One of them is that your portfolio is ready. You calculate your beta in a rolling window, and then you just short S&P as much as the exposure. The other approach is to already subtract it in the asset level. So for every asset, we can calculate beta and subtract S&P from it. All right, so thank you very much for the interest.
So now you have more factors.
Now we have like 30 factors. Yeah.
A technical question. About the commercial question, where is your service about your company in Spain?
Here is our office.
But